The Tesla stock price is currently trading intraday at $398.50, marking a solid upward move of 1.04% on the day, with shares navigating a daily trading range between $384.70 on the lower bound and $402.52 at the session peak. While the retail crowd watches the daily chart flashing green, a much quieter dynamic is shifting underneath the surface, specifically within institutional derivative positions where sophisticated block traders are aggressively buying out-of-the-money puts expiring over the next 2 weeks. This indicates that while the immediate momentum appears constructive, large funds are paying heavy premiums to hedge against a severe downside break, setting up a sharp conflict between retail optimism and institutional defensiveness. The general consensus across popular investing sites is that the recent stabilization near the $400 mark represents a clean technical launchpad, supported by promises of widespread self-driving capabilities and the massive capital investments poured into autonomous computing infrastructure. Investors opening their retail accounts or looking at their individual brokerage holdings often view these structural dips as simple buying opportunities, confident that the long-term automotive dominance will inevitably reassert itself against traditional competitors. However, a closer look at the actual operational numbers reveals a starkly different reality, where massive capital expenditures approaching $25 billion for the current calendar year are structurally crushing free cash flow and forcing the core automotive margins down to a razor-thin 3.9%. This huge gap between what people expect from a tech powerhouse and the reality of an asset-heavy industrial manufacturer creates a difficult situation for anyone trying to justify the stock trading at a high price-to-earnings multiple well over 360. Active traders managing their portfolios through platforms like Interactive Brokers trading systems or tracking institutional block orders via the Robinhood app are noticing that the massive execution risks of scaling physical artificial intelligence are starting to catch up with the market narrative. It is easy to buy into the big vision when looking at a simple smartphone app or reading broad analysis on various online investing platforms, but the execution of these high-cost projects requires a steady flow of cash that the current car business is struggling to provide on its own. The trading volume today has already surged past 58 million shares, beating the 30-day average of 52 million, which shows a lot of institutional back and forth as big funds try to figure out if the current support level will hold or if the stock is about to break lower. If we look closely at the recent daily swings, the stock has spent the first few weeks of June navigating a highly volatile range, dropping more than 6% in a single week before finding temporary support at the $384 structural shelf. Part of this volatility is driven by external corporate movements, particularly the massive market noise surrounding the recent SpaceX initial public offering, which has forced retail investors to decide whether to keep all their capital tied up in the electric vehicle brand or split their retail capital to chase the aerospace listing instead. Portfolio managers utilizing self-investing strategies or balancing assets within accounts at Fidelity Investments are looking deeply at the potential for retail-based fragmentation, especially since retail investors hold roughly 40% of the float. When large blocks of shares are shifted to chase new listings, the underlying equity loses the aggressive retail bidding pressure that historically rescued it during deep technical pullbacks. The technical simple moving averages are reflecting this hesitation, with the stock currently struggling to stay cleanly above its short-term exponential clusters, turning old support zones into new overhead resistance areas that require a huge amount of buying volume to break through. Comment below how many shares of Tesla stock you currently hold in your portfolio right now, and whether you are buying more or cutting your position at these levels. Looking back at the historical framework, the company built its massive market capitalization by proving that high-volume electric vehicle production could be intensely profitable, shifting from an early struggle to survive into an absolute cash cow that dominated global delivery metrics throughout the early part of the decade. The underlying business model relies on selling premium electric vehicles, utilizing vertically integrated battery manufacturing, and building a massive global charging network while expanding into utility-scale energy storage products like the Megapack to diversify revenue away from purely automotive sales. In past years, this multi-pronged approach allowed the business to achieve peak margins that left legacy car makers scrambling, driving the stock price to historic highs and making it a staple holding across major index funds, automated accounts like Schwab Intelligent Portfolios, and individual brokerage accounts worldwide. But as lower-cost competitors scale global production and price wars drag down average transaction prices, the reliance on high-margin software upgrades and autonomous driving subscriptions has shifted from a distant future expansion into an urgent structural necessity required to keep the valuation from falling apart. Looking out at the future path, the stock faces a clear set of distinct catalysts and significant structural risks that will determine whether it can break back towards its previous record highs or test new macro lows. The primary upside catalyst depends entirely on meeting the aggressive timelines laid out for widespread autonomous vehicle commercialization, where turning regular consumer cars into revenue-generating assets could instantly rebuild corporate profitability and justify the immense premiums demanded by growth investors. Conversely, if the $25 billion capital expenditure plan continues to drain cash reserves without producing a clear, legally approved autonomous revenue stream by the end of the year, institutional support will likely erode further, forcing a major reassessment of the stock down towards realistic industrial multiples. This structural tension between the bold tech expectations and the real-world manufacturing limitations creates a high-stakes environment where any miss in quarterly delivery numbers or regulatory setbacks with software approvals will trigger massive liquidation across online investment networks.
For investors building long-term positions or managing risk through diverse setups like Fidelity mutual funds or Interactive Brokers platform tools, the core focus must remain on actual cash generation rather than corporate rhetoric. The contrast between the optimistic vision of fully autonomous transit networks and the reality of compressed margins, rising competition, and massive capital needs will ultimately dictate the long-term price trend, leaving no room for simple assumptions in an increasingly unforgiving macroeconomic environment. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Buy-backs. Like-comment-share this video to support the channel. Heart.